recorded. Cool. Well, good morning, everybody, and welcome to this session of Live and Learn. We had a really good session with Dan last week, learning about business protection and the sort of things that we should be thinking of as business owners to ensure our business is protected and we're protected personally as well. So we thought it'd be really good for Dan to come and share this with our clients as well. Dan is our financial planner. And I'm sure some of you have already spoken to Dan and with some help with either insurances or pensions or mortgages. And I shall hand over now to Dan.
Thank you. Yeah, so today I just wanted to talk a little bit about business protection, but rather than talking about just too much on individual products, I kind of wanted to go into a little bit of research that has been conducted over the last few years, where Legal and General went and asked some business owners, 500, so quite a few small business owners, how their business would react in certain situations, what they already had in place when it comes to protection, and what their thoughts are on it. So I just wanted to share a bit of that research with you, and then just talk around some of the things that the research brought up, really, because some of it is actually quite interesting. So as part of the survey, as I said, they went to look at spoke to 500 different business owners, and essentially just trying to get a feel of what's going on. But before they did that, they had a little bit of a look at the market segment just to see kind of where most businesses lied. And in 2020, out of 6 million businesses in the UK, 96% of them were considered small, so 10 employees or less. So that's a very large chunk, and the majority of the businesses in the UK that are normal, like the rest of us, small businesses, yeah, just trying to make their way, really. They then kind of looked at when these businesses started, which I actually thought was some of the most interesting part, is the majority of the businesses of 10 employees or less, these 6 million, started within the last 10 years. So that's quite a short time frame, actually. That's a lot of businesses that have started recently, and that essentially splits near enough half and half between the last 2 to 5 years, which has probably been the toughest time for most through COVID and various other different scenarios, going back to the 10 years. Very few businesses have been going long, like the long term, so kind of 15 years plus. I also thought it was quite interesting, kind of the split between female and male owners. It's pretty close, to be fair. That's probably closer than I thought it would be. And I also think one of the kind of interesting thing about this is I was also very surprised about the age of a business owner when they start to 40, which is quite a prime time in people's lives, really. And it's quite a big decision to take at that age, to jump in and start a business, because you would have had quite an established number of years either being employed and building up your wealth, and it's quite a critical time in your life. So I thought this kind of data was quite interesting. But essentially, when we kind of look at businesses, and especially with businesses that have 10 employees or less, there's lots of different things that they have to juggle, and we have to juggle. Whether that be, if you've got employees, making sure that they're, there's enough money to get them paid so they have food on their table. Whether if it's just yourself as the line director, are you getting enough in for you to be able to achieve what you want to achieve? What would happen if you couldn't do that? Is it key people? So within the business, you as a director, do you have someone else that helps you that might be responsible for all the contracts and everything you're bringing in? Essentially, all these building blocks make up your business. And without the business, and you as the business, all these building blocks could fall down. So before getting into the different areas of what business protection looks like, what you can do, what you can't do, and the advantages, disadvantages of doing it, I thought it'd be quite interesting to share some statistics on what the chances of something happening to you or someone within your business looks like. So this scenario here takes on a 45-year-old male non-smoker between age of 45 and 67. So in that age gap, the chances of something happening to them. And when I say something, the scenarios that we're looking at here is chance of dying, chance of suffering a critical or serious illness, or unable to work for a month or more. The interesting thing about these scenarios here is your chance of dying is 5.7%, chance of suffering a serious illness is 16.4%, and unable to work for a month or more, 32.1%. Now, I think the interesting thing about all of this and kind of looking at these statistics here is, as a lot of business owners, they see kind of the value in insuring computers or machinery or public liability insurance and those sort of insurances. But these as a total here are quite big percentages. And we go back to the building blocks of, you know, the previous slide with all the blocks underneath the roof of the business. Does the business really fall apart if a laptop doesn't work and you have to replace it? Does it fall apart if, I don't know, a piece of machinery breaks and you call your insurance, make a claim to get someone out to fix it? Not really. But could all those building blocks fall down if you or someone that was key within your business died, or whether they suffered a serious illness and they were unable to work, or suffered from anything from mental health conditions all the way through to broken legs to something more severe, which, touch wood, doesn't happen? You know, what would those building blocks of your business still stand up? But if you combine all of these together, so the chances of one of these three events happening to you, dying, suffering an illness, or unable to work for a month or more, it's 40.5%. That is a big, big chance that something happening within your business could make it all fall down, which isn't a cheery subject, but it's an important one to kind of talk through. I wanted to kind of make this kind of as relevant and up to date as we possibly could. So I thought it'd be interesting just to look at the effects of COVID and the borrowing differences that has had on businesses. Because I think when we've kind of had all the grants and furlough and CBILS and bounce back loans and all these different events and funding that's been put out there for businesses, it's made it extremely cheap for businesses to get funding for things that they might have wanted to do, or even just to meet the bills that they need to meet over the time of COVID, whether they had to close or however it might be. But the interesting thing here is this is a split of all the different borrowing chains that has happened over, well, since COVID-19 started, really. And I think the most interesting one is the 45% that sits in bounce back loans, which kind of puts the average COVID borrowing at 122,000, which is quite high. It's quite a big number to find, to deal with or to pay back on a regular basis. So kind of, we've gone through a bit of the statistics, a little bit of what makes up your business, the building blocks of your business. But what is business protection and what can you look to insure and what can't you insure? There's kind of four key main areas, and One of them I'm not really going to go into much detail on, but the other three I do want to spend some time talking about, really. So the first one is debt. Now, when we go on through slides, you'll see this, but it's becoming more and more of a concern within businesses. It's kind of the debt levels that are held and how businesses run. It's kind of a key consideration. Key person, which is less of one I'm going to concentrate on. And the reason I kind of say that is, I'd say for the majority of us on this call, the key person is going to be the director or the main shareholders within the business, which will kind of mean that the main key person will be covered under this option down here, which is ownership and shareholder protection. This is looking at if one of the shareholders were to die, what happens with the shares within the business, but we'll touch upon that as we go through. And the last area is personal protection. This is covered by two main different areas, so relevant life and executive income protection, which are both interesting subjects, really, because very few people know they exist and the advantages to holding them. I think before we kind of go into the different areas, it's important just to understand from the research that was out there, just from yourselves, and get a little bit of feeling, asking yourself this question is what is the reason that you haven't looked at these areas before? When out of the 500 people that asked, 46% did not see the need for any protection at all. 29% said it isn't affordable. 17% said no one told them they should have it. 9% said it's too complicated to understand, and 15% didn't get around to doing it. In reality, it'd be interesting to see how those numbers would change if it was something that was talked about more, if it was something that was kind of more in the mainstream for people to see and find out more about it. Because if we look at personal protection, these numbers are not the same. They're actually significantly lower. So a lot more people see the advantage of having life cover for their mortgage or critical illness for their income, just as examples. But I think the majority of these percentages here just say there is not enough knowledge around it, rather than anything too sinister. But moving on to that, they followed it up with asking the business owners, or asking business owners like yourselves, 3 different key questions. And essentially 94% of the owners said that if them or their other director or someone they employ was a key person and was responsible for the majority of the income coming into the business. 75% of businesses carry debt, and 6 in 10 businesses wouldn't be able to continue trading within 12 months of losing a key person, which is massive. And you kind of have to ask yourself, what would the impacts of that be? And it's not necessarily death that would mean that your business would cease trading on a loss of a key person. It's what if you couldn't do your job to the full potential that you do it now? I get a lot when I talk about these scenarios where people say, oh, I could still send emails and I could still kind of do admin and paperwork, and I could get someone else to do the rest. And that's really, fine, and it's an okay response. But would you really want to have to do that? I think when you look at these sort of things, you need to say, look at the differences between wanting to do that for your own mind, and for a bit of focus, and the difference between having to do that, because if you don't, you know, not just your business falls down, your personal situation falls down as well. When kind of looking at the breakdown of this, just looking in more detail at how the different stages of businesses are affected by different scenarios. And I think this is kind of important because as businesses grow, or as our own personal needs change, so do the needs of what we're looking to achieve, or the products that we would need to service that, they change as well. So for the 19% of newer businesses that were established in the first 2 years, if they were to lose a key person, 33% would cease trading immediately, and 33% would cease trading within 12 months. So essentially saying only 33% of those businesses would survive after losing a key person. Moving on to kind of the next stage, which is 2 to 10 years. This is when businesses probably do start to take on a little bit more debt. So whether that's going to the bank to get, you know, a corporate loan, or whether it be bounce back loans, or various different ways of obtaining finance. Overdrafts is another big one. 84% have some form of borrowing, and 28% have the highest amount of COVID-related finance. So I think it's quite easy when you're looking at this to forget things like the COVID finance, because the bounce back loan, for example, is a loan and it does need to be repaid. It's not something that, it's not a grant. It's not something that's been, that doesn't require repayment. It does need to be repaid. 26% of established businesses, so ones with 10 years or more, would be looking more probably at the shareholder side of things. So what would happen if a shareholder was to die? What I mean by this is probably the easiest way to look at this is if you're a business that has 2 directors, you're both as reliant on each other. If something happened to one of you, what would you want to happen to your business? This is just touching upon debt, corporate debt again, but I think the majority of this has kind of been covered in earlier, but I think it was kind of interesting to see the breakdown of the total borrowing. So business loans kind of account for the most of borrowing. Overdrafts is the next biggest. COVID finance is really snuck in there over the last few years as cheap forms of borrowing. Personal loans and directors' loans, which are all things that would need repaying if something was to happen to one of you. This, as we're going through and kind of establishing different needs of a business, there's a lot of things here that aren't kind of relevant, but I just wanted to say kind of the top one here, which is essentially the death of an owner or a sole director. 52% of businesses would really struggle with that. I'm pretty sure we're all in the same boat with that. If there's 2 of you running it, or a key employee, we'd all really struggle with that sense. Even your family though, and I think this is a one that is really key to kind of remember as well, is when we're kind of looking at this 52%, it's not necessarily either the business that would be the issue. It's what about your family? What about your loved ones? Because without the income of the business, that is key to the whole livelihood of your family. I think I'm not going to spend any time going on any more about key person, but I think shareholder protection is probably one of the most interesting areas that goes unnoticed. So this is essentially, if we're looking at, let's take an example of a business that is run by brother and sister. They're both directors of the business, and both have joint responsibility for running it, and both bring exactly the same to the party in terms of running and income to the business. Without getting too morbid and into too much detail about it, let's say, unfortunately, the brother was to die. The key thing to this would be what happens to the brother's shares within the business. And that greatly depends upon his situation. If let's say he didn't have a family, and it was just him, he wasn't at the stage where he'd had a family, then the answer can be quite simple, because he might leave it to his sister, and that's all okay. But let's say he did have a family. Let's look at the scenarios of, if he did have a family, who would the shares of the business go to then? Well, in reality, it'd probably go to his family, because it's an asset that's worth probably quite a lot of money. What situation does that put the remaining director or his sister in? It basically means now that she's got a business partner that she probably didn't want to have. It means that if they were a 50-50 owners, for argument's sake, that she now has to run decisions by someone that probably doesn't want a lot to do with the business, because they either they have their own life to lead, have their own job, or might not even pay any interest in the business. And they might potentially have to completely change how she pays herself. So the sister might have to completely change how she pays herself, because if she paid herself dividends and salary before, she might not be able to do that going forwards, because if she took dividends, she'd have to pay it to her brother's wife, because she'd be entitled to dividends as well. So it's quite a morbid and specific scenario, but that scenario is quite common, not necessarily in the same share percentages, or that can be between friends, if two friends run a business, or however it might be. It's quite a common scenario. And the interesting thing I think about this is the answers to how that share, if passed on to family, how that might be obtained back by the business, because that could be quite a key area to look at. This is the outcomes from the last survey compared to a previous survey of what directors have said would happen to those shares. So essentially, in 2019 versus 2021, the beneficiaries retained ownership and take an active role in the business. That's dramatically increased, that option, over the last 2 years. Beneficiaries will remain active in the business. So in the scenario that I've just used, this would be the brother's wife taking over and taking on a role within the business. Beneficiaries receive nothing, shares pass to the other business owner. Partner shareholders will buy back shares from beneficiaries. Well, this is I think is the most interesting one, because this over the years has become a less of a popular answer. And I kind of question, I think the slides as we go through will give us the answer to why this is reduced. But kind of the most worrying one's probably the next one, if the business was ceased trading, or this is also kind of a one that wasn't picked up in the scenario, but there is always the option that if the brother's wife didn't want to be involved in the business and wanted the cash, they could sell it to a competitor, or their share to a competitor, or to a third party. So I think going through those scenarios and kind of looking at shareholder protection, I think the most preferred outcome for everyone in that scenario would be for the sister to remain to get full control of the business, and for the brother's wife to get a payout that would mean that she could live her life to the standard that she wanted to live it. So then we're looking at, well, how would that be funded? various different options. So the first option is personal wealth. Well, you can see this is dropped, and I think that's looking at the year gap. This is kind of based upon COVID and essentially the fact of cash flow for people has gone down. There is a lot of businesses, obviously, that business has increased over COVID, but that business could have taken on more debt, which has forced cash flow down, or essentially people just don't want to use their own personal wealth to fund the share buyback. And if we're looking at a business, if we're talking about business being worth anything from, let's say it's worth 250,000, well, 125,000 is a lot of money to find from your own personal wealth. Loan from the bank. So this is kind of an interesting one, and has lots of different scenarios. Now, this has gone up, and this is, I think, the pure reason that this has gone up, the responses have been more people go and look to take finance from a bank is just around how cheap finance is at the moment. But you have to look at a few things. So when you're a business, and there might be two of you within it, if one of you were to die, how would the bank view that to the profitability of the business going forwards? So a lot of loans from banks to small businesses like ourselves are normally guaranteed on either the director or one of the directors. If the director it was guaranteed upon died, that would have been, the bank could potentially ask for that to be paid back, because what they will be looked to do is see how that affects the profitability of the business going forwards. So if you look at that from the scenario of then one of the directors dying and then you go into the bank and asking for more money, they might see that as a big hit to the future of the business and not look to give you a loan. They might not even refinance what you've already got, which is a big problem, and is one of the reasons why looking at protection for shareholders is so important. Because if one of the directors was to die, would the business want to sustain those loans, or would they want them to, the security to know that they're paid off so that they don't have to be dealt with? Proceeds of life policy being taken out for this purpose. Well, this has gone up slightly, but in comparison to the rest, other than the last option, it's relatively low. It is the most straightforward way to deal with it, and probably gives people the most reassurance. Just taking out a life policy to deal with buying back those percentage of shares from the other. But it is by no means the most popular option. Cash from the business is last. Well, if one of the directors has died, what are the options with that cash? There might be other loans within the business that need to be repaid first. Is there enough cash to buy back the shares within the business? Not all businesses carry that level of cash within them, especially kind of businesses of kind of 10 employees or less, because normally what the director is trying to do is get as much of that cash in their pocket or our pockets as tax efficiently as possible. They don't want money hanging around within the business if it's not for later down the line or a specific purpose. Last option is own pension. This brings lots of issues. One of the main being, can you access it? If we look at the primary age of people setting up businesses, kind of on the second slide, being 40, well, you can't access your pension at 40. So that becomes a big problem. How are you going to buy back the shares? The easiest and most effective way to do it would be taking out a shareholder protection policy, which is whereby one of the directors of the business would both take out a protection policy for their respective shares within the business to the value. So if it's worth 400,000 and they're both 50-50, then they both take out a £200,000 life insurance policy. This is set up within a business trust, which essentially means that the proceeds pay out to the family estate, with the shares to the business being given back to the other directors. You would need to set up a cross-option agreement to how this is done, but most life insurance companies do that for you as part of the process of setting up a share option and shareholder protection. But the beauty of this means business can continue trading. The directors are happy because they get, the remaining director is happy because they get their share, they get the full control of the business. The family's happy because they get a payout of what they need to continue to live the life that they want to lead. And it just takes all worry and concern out of the business. Moving on kind of from the business side of things, I think it's important as well to look at personal. So how can the business help you on a personal basis to meet your own life cover needs? Well, there is such a way it can do it, and it's called a relevant life plan. I mean, from the respondents, the 500 people, 64% haven't heard of what a relevant life plan is. Whether 86% want to know what it is something else, but it is quite an interesting way of meeting your own personal needs. So what is a relevant life plan? So a relevant life plan is a type of protection policy that the business takes out for a key employee, which in our cases would be you, the director of the business. You would take this out in your own name. The business take it out to ensure you as the main person insured. Policy is written in a certain type of trust, which basically means that if you died or are diagnosed with a terminal illness, the trust pays out to who the beneficiary is. It's a really tax efficient way of doing things, because essentially by putting it into the trust, the money from the proceeds of the life cover does not form part of your estate for inheritance tax purposes. And payout happens really, really quickly. Rather than it forming part of your estate, for inheritance tax purposes, it stays all outside of that, and getting caught up in probate, the trust stops all of that and makes it go to exactly who you want it to go to at the time that it needs to go there. Now, it sounds remarkably similar to just taking out a life insurance policy personally yourself, but there is differences and advantages and disadvantages to it. So who can take out a relevant life plan? It's essentially business owners. So it'd be anyone that the business sees as wanting to give kind of the extra benefit to, because it's essentially a death in service plan, but specifically for an individual rather than having to set out for everybody. So what are the tax advantages to it? So for the employee, it's not classed as taxable remuneration. So there's no P11D benefit in kind. And also you can add kind of interesting things like pension contributions can be covered within it. You can set the sum assured to whatever you want it to be. So essentially you could kind of sit down and go through the process of what you would need maybe to pay off your own personal mortgage, make the contributions to your pension that you wanted to make, and then maybe a little bit for lifestyle. And you set that up on that basis, and the business would pay it. And these would be the tax advantages to you. To the business, it's allowable business expense. It's corporation tax deductible, and there's no employer's national insurance on it. So it's an extremely tax efficient way of insuring yourself. I kind of have done a bit of a savings example here for you, so you can see the advantages of it. But if we look at an £83.33 monthly premium, if you did this personally, to get the £83.33 into your pocket to pay the premium, these are the additional costs that you need to factor in. So the first one is employee national insurance, which is £1.44 based upon £83.33. Employee income tax, £28.74. An employee, if you're going to pay yourself via dividends, then dividend tax at £20.06. which gives you a gross earning of 133.57. So to get £83.33 in your pocket, you need to pay out 133.57. There is employer costs as well, which is national insurance at £9.91, but you will get the corporation tax deduction, which gives you kind of a total cost of 129.85. So if you're going to net it across the business and to yourself personally, to get 83.33 in your pocket, you've got to pay 129.85, which is quite a reduction, really. Via a relevant life plan, it's simply your monthly premium, 83.33, paid by the business. You get corporation tax deductible, so 15.83, which give you an adjusted cost of 67.50. So it's a saving of 62.35, which is 48%, which is massive. It's a huge saving to the business, to yourself, and also helps the business with tax. I think the most common reason that you would look to do this type of plan is to protect your family and yourself, but you can see the tax advantages to it, and it's not well enough utilized. There is some disadvantages to the plan, which is essentially you can only take it to age 75. Now that's not a big problem for everybody, but some people do want to be insured for longer than that. But there is a massive advantage to it as well, which is if the business ever ceased to trade, you can convert your relevant life plan to a non-relevant life plan. You cannot convert your plan the other way around. So if you already have a life insurance plan, you cannot convert it to a relevant life plan. Going back to kind of the building blocks of the business, and the percentage terms of the likelihood of events happening to you, this kind of area is looking at that 32% of people that are off work for a month or more. How would that affect you personally? How would it affect the business? And what can be done about that? This here is a list of how people currently see how they would survive. So statutory sick pay only 36%. Statutory sick pay is ridiculously low, and I'm not sure how anyone could actually survive on it. Sick pay via payroll is an ongoing expense, which is absolutely fine, but most of us rely on ourselves for most of the business that's brought in. So if we can't work or struggle to work to our full potential, can we meet our ongoing expenses? And if so, how long can we do it for before we actually start making ourselves worse, or through fatigue and stress and other issues? Could it hinder our recovery? Company sick pay via an insurance policy, it's not really relevant to the majority of us. I don't know is quite a common response, and other, I'm not sure what that includes, but it'd be an interesting one to see how that breaks down. There is a specific way that this can be done, and I think the way that you can kind of look to cover yourselves in this scenario is executive income protection. Now, what this would do is essentially, if you were off work for any reasons, could be mental health to musculoskeletal issues to things that are more severe like cancer, stroke, there's no kind of definition of what it has to be. The only things that it won't cover you for is loss of earnings due to just business drying up, holiday, and kind of business cease trading. But any reason why you're off due to sickness, it would kick in and pay a monthly income. Now, what that does is it takes the pressure off yourselves to have to work, and means that you can do it as more of a take your mind away from things, give yourself a healthy distraction rather than giving yourself the stress of having to work and potentially hindering your recovery. The other thing about income protection as well is there is two different ways that it can be done. So there is personal income protection and there is executive income protection. Personal income protection, very, very similar to a normal life insurance policy. It's paid by yourself out of your monthly income. The advantages to it are any payments that is made to you is completely tax-free. So if you insure yourself for £2,000 a month, you will receive £2,000 a month. The disadvantages to it are, if you look at, we look at the age that we took those statistics on, which was 45, the percentage chances of things happening was age 45. That, if you're off work long term, is a long time to not do things like save towards a pension or start building up other provisions so that when you retire, you do have something to fall back on, or when the income protection payments stop, you have something to fall back on. Because a personal policy is not classed as relevant earnings, which means that you cannot use that to make your personal pension contributions. So even if you did have enough income left over from your income protection policy to make them, you're heavily limited to $3,600 a year. Now, is that going to meet your needs to build up the retirement pot you're going to need? Probably not. Because the beauty about these policies is they will pay out for as long as you need them to. And so essentially, they will stop paying out either at the point you return to work or the policy ceasing, which normally is state pension age. With an executive income protection policy, it's a lot more tax efficient because it's not classed as taxable remuneration. It's not P11D benefit. It's allowable business expense. It's corporation tax deductible, and there's no employer's national insurance contributions. So it's exactly the same as relevant life. But there is some other advantages to it as well. You can cover your pension contributions within the executive income protection plan. So let's say within your business, I kind of mentioned when we looked at the ways that you can fund the buyback of shares about removing cash from the business into yourself personally via pension contributions. You can ensure that removal on a yearly basis. And let's say you're in the scenario where normally on a regular basis every year, to work towards your own retirement goals and to save tax, you put in 20,000 a year into your pension, or 10,000 or whatever number it is. Within an income protection policy, you can insure that £10,000 to make sure that that does continue to go into your pension every year for this foreseeable, for as long as you are not working and the policy hasn't reached the end of its term, which is a major advantage because it means that you can not only be off work stress-free, you know that your retirement isn't affected, so you'll have stresses in later life. The downside to this, to executive income protection, is how it is taxed, the tax treatment to you personally. So a personal income protection policy, the income is tax-free. In this type of policy, it isn't. So how it works is the payment is received by the business as a trading receipt, paid out to you kind of from sick pay, so it's treated as a trading expense, which gives it a neutral tax position, but it is paid via PAYE income, so it has income tax and NI deducted. So you would insure yourself for slightly more to allow for those payments. But I think you can see it's a lot more advantageous because it takes a lot more weight away from you. This is an example I kind of put together of a personal policy, an executive policy, and kind of the differences of how it will work. So if we look at the benefit amount of a personal policy, this one's 56,000 per annum, which is paid tax-free. Your annual premium is 1,029 per year. To get that into your pocket, you'll have the same costs, which employee national insurance, employee income tax, which means the gross earning needs to be 1,774.14 to get the 1,029 in your pocket. You've got employer national insurance at 244.83, which gives you a total gross cost of 2,018.97. We'll get corporation tax deducted on that, which means to get your £1,029 into your pocket, you've got to pay £1,634.37 for it. Moving over to income protection. To get the same benefit amount net in your pocket of 56,000, you need to insure yourself for roughly 97,827. This also ensures pension contributions of 8,000 per annum as well, but the quote for that was 1,776 per year. The advantages to that is this is paid by the business, which essentially means your 1,776 has no other tax costs or employer NI or personal NI to consider. It's a corporation tax expense, which means the net cost is 1,438.56, which is a £200 per annum saving, which is a lot for a lot more peace of mind. Who's it for? Company directors. It's just a tax efficient way to provide yourself with personal protection. And essentially for small businesses, and will cover you during periods of sickness, just give you peace of mind. Now, when talking about these different policies and how they work, the most common scenario I get, the most common question feedback I get is, oh, it's insurance, they don't pay out. So I thought I'd pull up some statistics. These statistics are from Legal and General, but these are the 2020 claim records. So if we look at life insurance, the payout rate for that is 97%. So 97% of claims they paid. Now, when we look at the claims, and that's 97, they have to register everything as a claim. So if someone rings up and tries to claim on a policy for something they're not covered for, that will go as a claim, but obviously won't pay out. Now, the other scenario is, well, they will not pay out if you lied on your application. So within that 3% will be claims, will be either people that lied on their application or people that have tried to claim and they're not eligible for it. Terminal illness is essentially something that sits in between life cover and critical illness. Now, critical illness isn't something I've touched upon within these slides because it's very difficult to get it within a business tax efficiently. It is kind of, when we're talking about shareholder protection, it is something you should really think about in terms of, you know, within that as well, but it's not of great focus for what we've been discussing today. But if we look at the income protection claims, which is the last column here, 93% of claims paid. Now, I would expect that to go down for income protection from your 97% for life to 93% for income protection, because it's a much broader scope. So there will be people in there trying to claim for business drying up and maybe trying to claim too early. So when you set up an income protection policy, they're set up for periods of time that you cannot claim for. So you might take one out with a waiting period of 4 weeks, which means that you have to be off work for 4 weeks before it will start to pay out. If you ring up before that 4 weeks, that will go as a claim, but they won't pay it out, which is part of the reason why the claim statistic is less. But I think the most interesting thing when you look at income protection, if you go down the list, it's the length of average claim. So the average claim is 4 years. So the average time that an income protection policy needs to pay out for is 4 years, which I think's quite, sorry. There you go, which I think is quite a long time. That slide obviously doesn't like me. We'll do it from here, which I think is quite a long time. I kind of think the other interesting parts of this is the youngest claimant. So the youngest person that's claimed on a income protection policy from Legal and General is 19. And the eldest is currently 62. The average age that someone claims is 41, which I think is remarkably young for someone to be off work for at least 4 years, potentially longer, potentially slightly less, but average of 4 years. If we take that back to the first slide of what percentage of people start businesses, well, it's roughly the same age, isn't it? It says 40 to 40 was the average age that people start businesses. 41 is the average claim. The split between male and female, that changes drastically every year, to be honest, so I wouldn't really take much notice of that. But I think the top 3 claims is always the most interesting one. Now, this list, if you look back statistically over time, isn't normally in this order, but for 2020, the top claim was musculoskeletal issues. So that's anything from bad back that keeps you off work long term, and lots of other different issues. The next biggest claim was cancer at 17%, and the last one at 12% is mental health. Normally, mental health is either first or second, but for some reason in 2020 that order changed. But I think it's important just to understand these numbers to say that these policies are designed to pay out. 93% of claims are paid for income protection. 97% are paid for life insurance. So whether that's relevant life, shareholder protection, a personal policy, that's 97% of these pay out. So it's an incredibly effective way of insuring yourself with a very high level of certainty. If you need to make a claim, it is going to do what you need it to do. Now, there was a last slide that had kind of anyone have any questions, but I dare not pull it up in case it ends the sharing and the call again. But that's everything I kind of had to run through. This isn't kind of the only areas that I cover when it comes to financial planning. I'm a fully independent financial advisor and do everything from pensions, mortgages, cash flow planning. So we sit and build cash flow models of your assets, of how they are now, how you can expect them to look in retirement, and the level of income you can expect to receive during retirement. So we can build budgets and cash flows and things like that for your life, for where it is now and where you want it to go. But yeah, that's everything that I had to run through.
Oh, thank you, Dan. That was even hearing it for a second time, that was really interesting again. We've had one question come in already, and it was referring back to the shareholder protection when there's the 2 shareholders.
Yeah.
And obviously you mentioned then about the shares being valued or the company being valued. What happens if the value of the shares or the business goes up or down from the point of when you take the policy out? Is that something that needs to be reviewed, or how does that work?
We review it on a regular basis, but to combat that, we can do one of 2 things. We can set the insurance to go up in increments. So you can either set it to the retail price index or a set percentage. So we'd sit down and say, maybe over the last 5 years, your business has grown by 8% a year. Well, you can have the insurance grow at 8% per year, but you would review it on a regular basis. But it is always a good idea to have those step ups built in, because if your medical history changes after taking out a policy, it could be difficult to get a new one or make changes to it. So yeah, we would kind of build in some form of growth combat.
That's cool. And I probably speak for the majority of business owners here, where my immediate thought when you think of income protection or any of these protections is, first of all, it's not going to happen to me. And second of all, even if I am ill, I'll still work because that's who I am. But I think you hit the nail on the head earlier when you said there's one thing working to keep our mind off of things or occupied or keep us in touch with the business, but there's another thing of having to work because you need the money. Yeah. And I think when you said that when we spoke about it last week, that kind of really hit home for me as well. It's one of them things, isn't it? And yeah, I know, I'm sure many other business owners are like me and think we're invincible, it's never going to happen to us, and then it does.
Well, that's kind of why I wanted to start with the statistics. And I know doing the statistics at the start makes it a little bit disjointed, but I think it's important because, there is this perception of it's not going to happen to us. But then you look at the statistics of 1 in 3 are going to get cancer at some point. The chances of one of those 3 events happening to a 45-year-old between 45 and 67 is 40.5%. If you take that out, if you take that 67 to 70 or 75, that percentage jumps. It goes up a lot. So, it is quite likely to happen to us, unfortunately.
It is, isn't it? It's quite sad to think, really, isn't it? And the other point as well, where you said obviously the relevant life, you can switch from a relevant life back to a normal life policy, but you can't switch the other way around. So if people have got policies at the moment, which are the old ones, and they wanted to look at going to a new relevant life so they can go through the business and everything, what would be your recommendations for doing that?
Talk to someone as soon as you can, because every year that goes past, life cover becomes more and more expensive, and the longer you leave it, it could get to the point where it isn't worth the change. Now in reality, that's quite rare, because life cover should be reviewed on a very regular basis, because our needs change. Our income changes, our lifestyle changes, it grows as a business grows, or does the opposite. So the chances are that a policy you took out 10 years ago being the right sum assured for you over the right length of time is quite slim. So it probably, would be a benefit changing it. But the main point is if at any point it did need to be like for like, the earlier you do something about it, the better.
And don't cancel current one until you've definitely got new ones out.
Do not cancel existing insurance until you've been told that the new one is live. I've had that scenario with another advisor in the past.
Yes, that'd be just my luck, I think. And I actually looked into this, and I can't swap over because things have happened since I took out my initial life policy. So now I cannot get the relevant life. So yeah, I've been there, done that. But
I'm the same. Yeah. I can't get it now.
No, but at least I didn't cancel the initial one.
Yeah, exactly. And there is other things we can do. And I mean, there is lots of areas of business protection that we didn't cover. I mean, there's key person insurance, there's critical illness. There's lots of different areas that we didn't cover. But you would have been here a long time, as Cheryl's team found out the other week, if we started going through all the different insurances you could hold and how they could be held. But the interesting point about last thing, I'll just say upon that, the interesting thing about shareholder insurance is you just need to be aware that it is something your business needs. It is a benefit in kind. Yeah. So it is a P11D benefit.
Yeah, that's fun. Well, thank you so much. There's no other questions coming in at the moment. what I will do is I'll obviously send out the recordings for everybody. So, because I can't tell how many people are watching live on Facebook. So I will send the recording out, and I will forward on any questions that we get so you can answer them.
Oh.
And yeah, so if anyone has got questions, please do let us know and we can pass them on. But yeah, thank you so much, Dan. That was really, really interesting again, and lots of things to think about there, and things that we will touch on as well in our annual reviews with clients, just to get you thinking about it again, because I know it's one of them things that you think, oh, I'll do that, and then quite easily forget again. So we will be just double checking that people are protected, or got the protection they want, should I say, in their annual reviews as well. Oh, well, thank you
for inviting me on.
Thank you, and thank you everybody for watching as well. I'm going to close it all down now, and yeah, I hope to speak to you all soon. Take care.
Thank you.
Bye.